Welcome to the Startup Grind.
Today I'm going to talk about three major disruptions that are going to be affecting you in your industry. And I observed one of these disruptions while I was living in Mexico. I like to call myself the entrepreneur mayor of Mexico City. I just gave myself that title. And the story of what we're talking about was born when I was invited to help create the venture capital industry a few years ago. We were just raising our third fund in the United States, and we had been researching emerging markets. I had put a growth equity fund in Latin America, and I got a call from the vice president of NAFIN, Jose Antonio Aguilar Bueno, and he said, I need to meet with you. And he flew out to the United States and met with me, and he said, we've done our homework, and we want to invite you to help us create the venture capital industry in the country of Mexico. I said, wow. I went home and told my wife, we just got invited to create an industry in a country. And she's amazing, and we were up for it, and so we did it. We took on the challenge. We moved to Monterrey, Mexico in 2009, and you know, we thought this would be an amazing opportunity to help lift the country and help change the dynamics in Latin America. One of the challenges, though, we were trying to come up with what was the name for the industry. Since they didn't exist, venture capital was not a word that was widely used in Mexico. The word that was used was capital de riesgo. Capital de riesgo. Anybody know what that means? Risk capital. For those that speak Spanish, how does risk capital sound to you? Risky. And right there next to nuclear waste. It is, in one of the translations somebody told me was, it's like, here, give me all your money, you're going to lose everything. And so we couldn't start an industry around a name que suene so feo, que sounds so ugly. So we needed to rename the industry. So I went to the Tec de Monterrey and a student group. This is the largest private university system in Latin America. And we met with the student MBAs and the student business students and said, we're going to rename this industry. So I had groups that went out, came back, and they proposed all these different names. And the most controversial one was Capital Aventura. Now you'd say, well, that makes sense. Venture capital, Capital Aventura. But Aventura has another connotation in Mexico. Anybody? It means to have an affair. So affair capital. I don't know. That's probably a little above, you know, death capital. But and so the name that won was Capital Emprendedor. This is called entrepreneur capital. Now, why didn't we call that the United States, entrepreneur capital? Because that's what it's all about. It's about entrepreneur-centric, supporting the entrepreneurs. And so we're going to talk about the rise of entrepreneur capital in Latin America. And we have, our fund has offices in Monterrey and Mexico City, and we just opened in Guadalajara. So we're going to talk about, about one of the first disruptions that's happening. And so there's three disruptions I want to talk about today. One is a disruption to you and the people that are around you and supporting you, and the incubators and accelerators and venture capitalists. So as an investor, this is the ready, fire, aim that Jared was talking about. This is the guys that go out to Startup Weekend and start building something without asking anybody if they wanted it. And eventually you get it right, don't you, if we give you enough money. The reality is most startups fail. And as investors, we are not increasing the odds of success. Josh Lerner at Harvard produced a study that showed venture investors are not increasing pure chance. And that kind of hurts as an investor, knowing that my value-added money is not increasing the odds of you getting it right. And I have firsthand experience. Over the years, I've had my share of failures, and probably more than I'd like to admit in public. One of the observations that I had, though, over the years, I invested in over 100 companies, is that a few entrepreneurs had a habit of getting it right over and over again. And they were doing things 180 degrees opposite of the textbook that we were learning in business school. I have to tell you about my biggest failure. It's the company up there called Cogito. We syndicated this deal in Utah with everybody in Utah, Utah Ventures, Wasatch Ventures, UTFC, Canopy Group, vSpring Capital. Every single fund was in that deal. So it sounds like it's a recipe that's, you know, it's foreshadowing great doom. We put in $13 million into the round. They'd raised $12 million before us. $25 million in, the company did not get a product into the marketplace. Painful. And I know why now. When I went down to Mexico, I was showing I was teaching a class, and somebody said, "Who named that company?" Cogito. I said, "Oh, the founder. Why?" "Oh, I know why it failed." "Tell me about it." "It's your name." "What does it mean?" He said, "It's the F word." I said, "Really?" I thought I spoke Spanish. It was one of those slang terms, but it's true because everybody got screwed in that deal, so it makes sense. Most entrepreneurs that are successful have no idea why they're successful. Bob Metcalf said, my success was a mystery to me then and only a little less so now. I want to ask you guys, as the experts of success or failure and living in that startup grind day to day, why do startups fail? Shout out. Why do startups fail? What are the top reasons? Okay. Lack of vision.
Founders give up.
Lack of focus. Founders giving up. No customers.
Improper use of money.
Using money incorrectly. Building the wrong thing. What's that? Not understanding their market. Not understanding their customers. Not lucky. What's the definition of luck? When preparation meets opportunity is my definition. Running out of cash? That's what Clayton Christensen said. He's going to speak later, and he said, tomorrow, he said, the startups that fail are the ones that run out of cash and can't keep going. It's true. We surveyed hundreds of entrepreneurs. I've invested into hundreds. Why do entrepreneurs fail? Let me give you very quickly some of the learnings. I've never met a startup that wasn't working hard, doing good things. But what I found was there's an order and a process to what they're doing. They're working hard to get across the chasm and get into this mainstream. But the reality is most entrepreneurs fail in this early stage black hole, pre-chasm. And up until recently, there hasn't been much research done about this pre-chasm failure area. All entrepreneurs are working hard to innovate, but very few understand what is innovation. Here's my definition. Innovation is the intersection of invention and market insight, where you have this great idea coming together with understanding of how the product fits into the customer's world. Great companies understand their core competencies. Most entrepreneurs I've interviewed do not understand their team's core competencies or how to leverage that core competency. Think about the core competency of Honda. The core competency of Honda is engines. And they build lots of things out of engines. What is your core competency, and how does that intersect with the market pain and your team's ability to deliver on that? I've observed great companies start small. 2, 3 people, someone to build it, someone to define it, someone to sell it. I've observed that most entrepreneurs, myself included, misprioritize our day-to-day activities. There are things that we can do to take out the deal killer risks early in the process. What Jared was talking about, before you raise a nickel, you can validate customer demand and your product fit before you raise $1. The number one reason startups fail is premature scaling. And this was research that was done here in Silicon Valley. To say it another way, it's doing good things but doing them out of order. Hiring a great VP of sales before you have a product to sell. Building your beta before you've done your alpha or your early pain validation. The roots of this failure go back to the traditional product development model called the waterfall development model. It's how large corporations talk to existing customers with existing pain and existing distribution channels. But as a startup, you have a different problem. You have unknown customers, don't have a distribution channel, you don't really understand the pain very well, but you're using a process that was designed for somebody else. Create your own process. So the disruption number one to the industry is the disruption of the startup process. The solution that is being talked about from everybody from Steve Blank to Eric and myself is bring that customer up front in the development cycle. Once you have an idea, as Jared said, stop. Go get your customer. Have a conversation with the customer about their monetizable pain. The guy that coined the term monetizable pain is Mark Richards. I saw him here. You here, Mark? Over here. So this guy that coined the term monetizable pain. Understand that pain before you take that next step. Are you capable of delivering on the product to solve that pain? and follow a process. So this is a process that's outlined in my book, Nail It and Scale It. So disruption number 1, the new startup model. Disruption number 2. Oh, by the way, let me give you some points of validation. How many people have heard of business model competitions? A few of you. So one of the points of validation of this is the business model competition I'm predicting will completely replace the business plan competition within the next 5 years. It was started by my co-author Nathan Furr, Steve Blank, and Alex Osterwalder got together, created this business model competition. Launched in 2011. 2012 they had 12. 2013 they're predicting 50 contests this year. The main event is going to be held at Harvard. Last year they had more than 10,000 business plan submissions in the country of Chile alone. And if you want to understand how to create a high potential startup that I will invest into, go to businessmodelcompetition.com, look at the videos, and click on the video Zoom Park. This guy had a really lame idea, and he takes you through step by step as a student how he came up with a company, and people are throwing money at his business. So death of the business plan competition, rise of the business model competition. Another contributor to this disruption is the fact that it's 100 times cheaper today to build your business. I'm not going to go into detail, you know all that. Disruption number 2. Somebody showed me this slide the other day, and they said this is the decline, all the tourists are going home in the venture industry. So if you go back to the year 2005, 1,229 venture firms did 1 or more deals in that year. Fast forward to 2012, 350 firms did 1 or more deals in that year. That's 2/3 of the industry went on vacation and went away. There's a massive disruption happening in the venture industry. Front page of the Wall Street Journal, section C yesterday, talks about the pullback that's happening in the venture industry. Talks about one of the venture funds up in Seattle fired 7 of their 9 partners and pulling back to a smaller fund size. I've been on the road. I've raised over $850 million in the last 12 years from institutional investors. They are frustrated. They're not getting returns on the asset class. And the model has not been sustainable for most of the investors in the marketplace. And the institutional investors are pulling back. They're not funding. This industry is going through a massive disruption. And some people are predicting an extinction. I don't call it an extinction. Now, nature hates a vacuum. So in this vacuum of the venture money pulling back, what's happening? Accelerators have gone crazy. 2005, there was 1 accelerator, Y Combinator. Today, we count over 150 accelerators as of today, filling this void of early stage financing. Is this another bubble? I believe it is. 90% of these accelerators will fail. Why? Because to date, only 13% of them have had an exit. If you're not generating liquidity, you're not going to keep doing it. And the Pareto principle says 80-20, 90-10. So the world's going to settle out, and there'll be a few that figure this out and disrupt this early stage marketplace. Y Combinator by itself has had 85% of all the exit value of all of the 150 accelerators around the world. So you have one that has 85% of the exit value. 48% of the companies associated with these accelerators have not received any financing. So half haven't gotten anything as a participation in that program. Have we seen this before? Go back to 2000. Yes, we have. So 1980, 12 incubators. 2000, there were 1,000 incubators. CMGI and all these high flying. And what happened to those guys? Not one of those guys succeeded. It was a different time, different area. They didn't have the cloud computing and all the infrastructure, and it wasn't 100 times cheaper to build your business back then. But as I've watched this, I know it's a bubble when my mom calls me up. I'm thinking about doing a bread accelerator. All right, so here's what's happening right now with the capital. The disruption, and we're going to call the disruption number 2, the rise of entrepreneur capital. As we see here, the number of early stage deals by the venture funds has had a 48% decrease since 2007. But look at the angel deals. 30% increase in angel financing. These angel groups are coming online early stage, and who are the angel groups? It's a mix. It's the online crowdfunding, it's silicon, it's the super angels, it's the seed funds, the pre-seed funds, accelerators. This class of entrepreneur capital is filling the void that has been left by venture capital firms that are leaving the space by force or by choice. And there's this vacuum that's happening here. In any major disruption, the disruptors come from below. And it's always that's not really a company or a market or a product. Think about, as Clayton Christensen talks about the disruption of the computer industry, the mid-range computer disrupted the mainframe computer. The PC disrupted the mid-range. Now, the mid-range customer went to their customers and said, do you want a PC? And the customer said, are you kidding? No, it's too slow, doesn't have enough memory, doesn't run my programs. I wouldn't use that. So existing customers in existing markets don't see the disruption coming. It's the new ones. How does that apply to the venture industry? It's the unfunded. It's not the top tier high flyer entrepreneurs in Silicon Valley. It's the others, and it's the other funding sources that don't have access to the best deals. So if you look at this disruption, it always comes down here and nobody sees it coming, but it comes up and it niches the previous marketplace. A lot of people are predicting a Series A cliff. I think this is a quality first world problem. Lots of seed capital. Seed capital is easier to raise now than has ever been in the history of the world. If you can't raise seed capital, you have not nailed it. But if you have nailed your breakthrough value proposition, your customer exchange, and your market pain, you have a high probability of raising seed capital right now. The problem will come with later on financing sources. But the good news is the angel investors and these early stage investors are filling that void. So here's what's happening. Number of post-seed angel investments. So this is after the seed. It has grown by 80%. So the angels are coming in, syndicating their deals, working with each other, and following their investments. The seed deals and the angels have dropped off, but others have filled the void. So angels are coming in and have invested almost the equal amount that the venture capital industry has invested. Think differently about your sources of capital. Angels, super angels, and these organized groups, and you have many, many, many more coming online. What I predict is there's going to be a niching of the venture industry. As these other groups come online, these communities organize, follow the best deals because they were in them early, and only the top tier venture capital firms will survive. They'll still be there. It's not going to go away. And that's kind of a hard prediction to make because that's what I do day to day. So it's really kind of difficult to see me in that box, but that's where I am right now, and I'm trying to get out. Accelerators are improving the model, and they're getting better. If we look at the number of companies done in the accelerator marketplace, Y Combinator is the gorilla, 468, followed by Dave McClure, 500 startups, I think over 130 now. And he'll tell you better this afternoon. He's probably got 300, was one of the numbers that I heard. In terms of the exits, $1 billion in exits for Y Combinator, and everybody else combined is probably about 100 million. Y Combinator is changing the market and the best practices here. 20,000K investment, you guys probably know these terms better than I do, 2 to 10% equity. They identify talent early on. One of the things I noticed is that Y Combinator has a thing called Hacker News. And you get karma points by participating in Hacker News. And one of the indicators that I believe Y Combinator uses is that they watch the Hacker News karma points. And they use that as part of the selection process to identify these high-quality hackers and engineers they want to invite into the process. Are they polite? Are they smart? How are they viewed by their peers? And that good engineers know good engineers. That's one of the quality inputs that we look for when we're making an early-stage investment. They have guaranteed follow-on, and that's dropped recently. And their alumni are, as of May of last year, were worth $7.78 billion. That's an average of $45.2 million for every single Y Combinator company that's ever graduated. Now, most of that's skewed because of a few big exits, a few big companies. They have not figured it out yet, though. They're still working on it. They shrunk their class this last winter from 84 to 50, and they dropped the amount of investment they're giving everybody. And Paul Graham just says, as they scaled beyond 66 companies, something broke, and so they're pulling the size back down a little smaller. All right, and so this is my biggest prediction. Prediction number 3 is that Derek Anderson. Wait. Where'd my picture go? Oh, Derek took it out. Oh, that is not nice, Derek. I had a picture of a big fro with Derek out here, and he got to my picture. Okay. I guess that's what happens when you control the conference. It was just a big old hairstyle. All right. The prediction was Derek Anderson grows hair, so I actually know that they changed it. All right. Well, thank you for your time today. It was a pleasure spending time with you, and